Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Sunday, November 23rd, 2025, and we're here to break down the latest market buzz from yesterday's data.
That's right, Ethan. We sifted through nearly 60 social media posts flagging three distinct stocks. And honestly, it's a real mixed bag today. We've got some very passionate bullish sentiment out there, but also some significant red flags when you look at the underlying financial health. It's certainly a market demanding careful consideration.
Absolutely. Let's dive right into our first contender, Advanced Micro Devices, or AMD. Now, the discussions around AMD are really interesting. Despite an initial bearish post, the community response was overwhelmingly positive. Users are pointing to some really strong signals here, particularly in the data center space. We're seeing mentions of their EPYC CPUs being highly valued for performance per watt, with actual reports of increased usage by major hyperscalers.
That's true, Ethan. The user sentiment is definitely leaning towards bullish, especially with those big AI GPUs for OpenAI, Meta, and Oracle. That's a huge positive for future growth, no doubt. However, when I look at the KPIs, my cautious alarm bells start ringing. Their price to earnings ratio, for instance, is through the roof at over 106. That tells me investors are pricing in an enormous amount of future growth.
Well, that high PE does reflect the strong revenue growth we've seen, over 35%, which supports the idea of increasing demand. And the stocks performed really well, up significantly from its 52-week low. It truly highlights the market's belief in their innovation in AI and data centers.
But even, we also have to talk about that debt to equity ratio, which is extremely high at 6.366. That level of leverage introduces a significant financial risk that isn't really getting much airtime in the community discussions. Combine that with a relatively low return on equity and return on assets for a company with such a high valuation, and it suggests that profitability efficiency isn't quite keeping pace with the growth narrative.
Given it was a cautious buy earlier this month and we're seeing these valuation and debt concerns, my AI-generated insight suggests a more cautious stance now. I hear you, Brooke.
The enthusiasm is there and the market potential is clear, but the numbers do paint a picture of a stock that's already running hot.
Exactly. So, for AMD, considering the current valuation and financial leverage, our AI-generated analysis leans towards a stay-away classification for new positions right now.
Next up, let's talk about Intel, INTC. The lead post was incredibly bullish, highlighting their advanced packaging technology and attracting big names like Microsoft and NVIDIA. It sounds like a fantastic turnaround story, doesn't it, Ethan?
It really does, Brooke. The idea of Intel's 18A tech improving voltage droop and securing major foundry customers like that, it paints a very promising picture for their future. And some users are definitely buying into it, with calls and significant share purchases. It certainly suggests potential for Intel to regain some of its lost ground.
Well, the community discussions definitely challenge that initial bullishness. There's significant skepticism about Intel's power efficiency compared to competitors like AMD, especially for data centers. And let's look at those KPIs, Ethan. An astronomical price-to-earnings ratio of 575? That is absolutely eye-watering and suggests the market is pricing in a perfectionist's view of their turnaround. Their earnings per share is a paltry 0.06, and revenue growth is only 2.8.
Yeah, those numbers are tough to ignore, especially when you consider the intense competition. But the foundry business, if it takes off, could really change those top-line numbers in the future.
It could, Ethan, but the news already talks about potential setbacks and deals faltering. And with a net profit margin of just 0.37% and a debt to equity pushing 40, Intel has very low room for error. This valuation, based on so much future potential that isn't yet reflected in the financials, just doesn't sit right with me.
We've consistently flagged Intel as stay away in previous episodes, and based on this current data, I see no reason to change that.
Understood. The forward-looking optimism is compelling, but the current financial reality is stark.
So, for Intel, our market commentary suggests a continued stay-away classification. The risks at this valuation are just too high. All right, moving on to Eli Lilly, LLY. Now, this is a company making huge waves. User sentiment is overwhelmingly bullish, driven by their leading position in the weight loss market. Hitting a $1 trillion market cap, that's massive, and users are raving about their superiority of GLP-1 drugs like Zepbound and Mounjaro with an exciting pipeline. You know, that triple agonist drug. Plus, over 53% revenue growth, Brooke. That's incredibly strong.
There's no denying Eli Lilly's market dominance and impressive revenue growth, Ethan. The company's products are clearly in high demand. However, the whispers of caution among users about its valuation are really important. Their P/E ratio is over 51, and while not as extreme as Intel's, it's still very high, especially when some users are comparing it to competitors like Novo Nordisk trading at a quarter of that.
Well, that high PE does reflect the market seeing a lot of runway here for their innovative drugs. And with strategic moves like their direct-to-consumer website and Medicare discounts, they're aiming to expand market access, which could further that growth.
It could, but at what cost to margins? Users are already pointing out that current pricing already reflects years of anticipated growth. If that growth comes with significant price cuts, as some news suggests, their earnings and profit margins could take a hit. Trading so close to its 52-week high, with so much future success already baked into the price, makes it incredibly sensitive to any slight negative news or competitive pressures. Eli Lilly has been a buy for us previously, but this latest surge, coupled with the valuation concerns, signals a different approach now.
So, despite the groundbreaking success and strong market position, you're leaning towards caution.
Absolutely. Our AI-generated insights suggest that at its current price point, much of the upside potential is already factored in. So for Eli Lilly, we're classifying it as a stay away for new entry right now, simply due to valuation risks.
All right, a really interesting day with a lot of community excitement, but also some significant risk factors, as Brooke highlighted. So, to quickly recap our AI-generated insights for today's hunt, investigate as buy. None. Investigate as cautious buy. None. Investigate as speculative gamble. Eli Lilly and Company, LLY.
And that wraps up our analysis for today.
Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thank you for joining us on the daily hunt for multi-baggers. We'll catch you next time.